Hi, and welcome to our weekly market update from Morton Brown Family Wealth. I'm Dennis Morton here with my partner, Katie Brown. Good morning, Katie.
Good morning, Dennis. How are you?
Good, good. So this is going to be the final summer session for our weekly market update. We've tried to pull forward some elements of our investment philosophy into some conversations due to recent volatility and what really an extraordinary first half of the year. Today, we're going to focus a little bit on kind of what defines a recession, because a lot of that talk has been top of mind recently. But then we really want to focus on the uncertainty that goes into that conversation. Are we in a recession? Are we not? Are we in a bear market? Are we not? And just some of the concepts to help, put that in context a little bit. So, Katie, you found an article about just what defines a recession and how fuzzy that can be sometimes.
Yeah. So there's a CNBC article, and it was, here's how to know if we're in a recession, and it's not what you think. And it's exactly, and I find it interesting because there are a lot of conversations around recession versus, just the acknowledgement of like a bear market, and then does that lead to recession? A bear market, you know it when it happens at the time. Like a bear market has a pretty standardized definition of, the major stock index is down 20%, the S&P 500 down 20%. You're like, okay, that's a bear market. A recession is very different in that it's not the official label of a recession very often doesn't come until months later than the actual, and sometimes it's even labeled a recession after the recession is ended, because there are a lot of factors that go into it, and it is squishy. A lot of times people think, or what has been historically correct before, or it's just kind of coincided, is 2 negative quarters of economic growth. And we're coming up on those 2 quarters, but there's more than just that goes into it, which makes it very unique this time. So Dennis, you want to talk about some of the other factors that are considered?
Yeah, so it's a lot of it has to do with employment. And in the article, they talk about, can you have a recession when we're adding 400,000 jobs in a month? We mentioned this in our quarterly market update last week about, is this if this is a recession, if they do deem it to be a recession, is it a job-full recession where we have 2 jobs for every person looking, and it creates an interesting set of circumstances, and almost calls to mind, how important is it that we label something? I think we all try and put things into tight little boxes and contain them, label them, and have those isolated in our minds. But a recession or a bear market, it's what is the impact on us if we have full employment, if things are pulling back. Like even this morning, I was listening to CNBC, and they were talking about Spotify and a couple of other content creators and technology platforms like Netflix, and they talked about how they're canceling certain projects. And you think, and there was a little bit of a doom and gloom tone to the whole conversation. And I just kept thinking, okay, so they're not doing something as quickly as they thought they were going to do it, or they're abandoning this project in favor of that. That doesn't seem doom and gloom. That's just a decision. Kind of like you and I, if something happens in our lives, if our income changes or our job situation changes, we make a decision. We don't, it's not cataclysm, right? And that's, and a recession is a change of pace. It's a slowing, not a stop, halt, right turn, sharp right turn, right?
Right. So the National Bureau of Economic Research, that's who actually makes the call as to whether or not there's a recession. And their definition of a recession is a significant decline in economic activity that is spread across the country and lasts more than a few months. There's a lot of different pieces of economic activity.
Yeah, it is. And I think that's what's so confusing right now. I think for a lot of us, we're looking around and we're seeing, if you go to, we had an event like, there was a Blues, Brews, and Barbecues out just outside behind us on the street earlier this week. A lot of attendees, people are feeling good. They're getting out doing things. It doesn't feel as though activity is slowing down. Spending is still pretty positive. consumer balance sheets are still in pretty good shape. So there's a little bit of a disconnect between what we're seeing in our daily activity and we're
Mhm.
hearing now. Granted, inflation is changing habits. So we have to recognize that people, there are definitely trade-offs happening based on, rising costs and everything else happening. But dollars are still circulating through the system. I just think it feeds into general confusion about what defines a recession and then how we're all acting in lieu of that. They said one of the experts cited in the article says the economy has never been in recession when at least three of those NBER indicators rose during the month. So I think that's what we're looking at is to say it could be a judgment call on whether we're in a recession or not, but there are still positive things happening simultaneous to that, and that influences it. And there's a term that I think is an important one called creative destruction. Are you familiar with that term? Have you heard that one?
I feel like we might have had some conversations around this, probably in the context of our kids.
Okay, I'll let you go there. Let's.
No, but it's part of the learning, growing process that you sometimes have to kind of tear things apart to be able to build it and build upon it better, and to build character and to build and to grow. So, and I'm sorry, I'm not sure exactly where you were going with it today, but
It wasn't there, but that's okay. No, no, but creative destruction. You're absolutely right, absolutely right, and that's really the silver lining in any recessionary period or any period of change is that the things that weren't going to work get washed out. Everything gets rinsed out with the tide. So it's Spotify abandoning one strategy in favor of another because we need to concentrate and focus and the exuberance, the confidence. We'll get to that in a minute. The confidence that's unearned gets thrown out, and you start focusing on the things that work. So it's that the creative destruction is tearing down those things that were unsustainable and building back from a stronger base. And I think I'm going to use a lean on a guitar analogy here for a minute. I was talking to someone, a guy I know who works for a guitar company, Martin Guitar, and he had an interesting point a couple of years ago when I asked him how guitar sales are going. And he said, well, this was probably 2016, 2017. He said, the economy's doing really well, so acoustic guitar sales are way down. I said, why is that? And he said, when everything's going well, the acoustic music fades to the background and you get a lot of electronic bleeps and blips and things like that. And there's a lot of just, music that's, think of the mid 1980s or something like that, and actually the mid 2000s. But when things fall apart, when you get the Great Recession or something like that, that's when people go back to the basics. They go back to, three chords in a song. They go back to folk music. They go back to the things that are timeless. And so you think back to 2008, 9, 10, the music that was coming out of that, it was the Avett Brothers. It was Mumford and Sons. It was, Ed Sheeran with a solo guitar standing on a stage in front of thousands of people. But it kind of cuts back to basics. That's the creative destruction. And I think we're getting back to basics now, bringing us back to the economy and the markets. You're getting back to high quality earnings. You're getting back to high quality bonds. You're getting back to the value of liquidity. All those things matter. So it's just creative destruction is kind of the silver lining of any recession, however you define it.
interesting. That's fascinating. I did not know that about guitar sales and how that in itself can be an indicator. There's always these little indicators.
We need to talk to Y Charts and see if they can do an acoustic guitar index. I'm going to leave that. It's going to be the Morton Brown acoustic guitar index to track economic activity. All right, so let's talk about this. This is the article that we really found very interesting. Uncertainty. So this is from Barry Ritholtz talking about the uncertainty monster. Katie, you really like this one. So you want to talk about what kind of the themes there?
Yeah. I mean, he starts out just acknowledging there are so many things that we are uncertain about right now. Once again, are we headed into a recession? What's happening with this inflation? I thought it was supposed to be transitory. What is I know jobs are strong right now. Are they going to continue with that? Companies are slowing down, like Walmart, companies are putting out there saying, hey, just going to raise a flag that profits might be slower. So there's, uncertainty of how this all comes together, uncertainty around Ukraine, and any geopolitical, challenges. Just it's continual, and and it's interesting because he acknowledges that, but then he acknowledges uncertainty is always present. The thing you never know what's going to trigger those uncertain moments, but uncertainty in itself is exactly the same in that it's always present, the future's always unknown, and it's not knowable. And so it's a state of mind, I guess, is kind of the point of it. And he had some really interesting notes throughout the article that I think resonated with both of us.
Yeah, and there's a question here in the chat. Are we talking ourselves into a recession? I think that speaks to it. Is that I think we talk ourselves into exuberance during years like last year when it's like, well, everything goes up, and this isn't not all of our lovely community, but there were people out there in the meme stock world, kind of retail investors who there was the catchphrase "stocks always go up." That was actually a theme last year. Stocks always go up, and it's that confidence in a singular idea versus a mindset. I think that's the difference. Is that I think sometimes we get sucked into either stocks always go up to the upside, or things are always going to get worse to the downside. And if you get latched onto that idea, it's missing the point. The confidence needs to be much more internal than external, right? Mm-hmm. That's kind of, frankly, that's why we're financial planners and not solely investment strategists.
Yeah. And it needs to be, my opinion, broader. Like you don't know what the specific nuance of the specific items are going to be. To say stocks always go up, it's too narrow. To say the stock market over the long term is positive is much broader. It's easier, I think, to accept and build in kind of broader terms, knowing that things underneath the hood are going to be constantly changing. Like this company A, company B, company C, it's not a guarantee that those companies are going to be positive. But all the companies kind of thrown into a basket together, there will be companies in there that are going to be positive over the long term, that are going to help, build that growth. So I think sometimes it's that narrow focus versus the broader picture.
Yeah, and there's an element of I think there's ways to feed into it. I mean, if you're watching TV news, if you're watching CNBC or Bloomberg, whatever it might be, the uncertainty is something they're trying to seek out. They're trying to find areas where people are uncertain about things and pull their stories forward, which is valuable in its own right. But at the same time, we have to recognize that it somehow misses the point. And they talk about just how confident we were last year projecting things forward. But what if somebody's sitting on a lot of cash right now, Katie? Uncertainty can be kind of have a paralyzing effect. It can say, I don't know what's going to happen, therefore I'm not going to do anything. Mm-hmm. But there's got to be a catalyst here to say there's a way to step into things or lean forward. An example would be, we talked about this last week a little bit, the significant increase in yield that we've seen. So, we've seen substantial increases in yield. If you were earning 1% on, a certain high quality bond 6 months ago, you're now earning 2.5% or 3%. That's a massive increase. And if uncertainty about whether we're in a recession or uncertainty about the economic future is causing you to not do something, then you're kind of missing the opportunity to step back and be decisive in a way that's constructive for you, and to say, like, wait a minute, there's a significant advantage here for me to seize upon. And there are other things that jump in there. So what are some things, because Barry Ritholtz in the article says these are lies that we tell ourselves. Our confidence is a lie that we constantly communicate. Mm-hmm. Are there counter stories or other things or truths that we can tell ourselves during times like this to help spur action?
I don't know. I think that's a good question because I think, I mean, the truth of the matter is certainty and uncertainty, they have to live together. It's a matter of finding that balancing act and acknowledging they're both going to be present. Nobody can predict the future. You know, how do I plan accordingly so that, I may not know everything that's going to happen, but I can prepare for there are things I can do to prepare for the unknown to help build a greater amount of certainty around, future success, but acknowledge there's always going to be stuff kind of running back and forth. So I think it's once again, I think it kind of goes back to the narrow and the broader scope. Be careful not to get pulled into a very narrow position of uncertainty,
Right.
or certainty. I think both of those can be dangerous. Like you said, last year there was so much certainty. I think, in a lot of areas about things are great and you're just going to keep making money, and this is the way to do it. So I think both of those need to be kind of tamped down, and we have to find that balance so that they can live, in tangent together.
Right. I think, we talk about when the alarm bells go off, and this comes back to the recession article. If someone says we're going into a recession, the alarm bell shouldn't be, hey, we're going into a recession. The alarm bell should be that person's certain about something.
Mm.
That's the thing that should be. And he talks about Business Week used to run an annual year-end preview, and they would have all the major Wall Street economists and strategists put together numbers and share forecasts and everything else, stocks, bonds, oil prices, GDP. And he says the results were so consistently and hilariously wrong that eventually Business Week just stopped running it. It was an entirely useless endeavor, and that's the thing. It's just, the thing we want to be experts on is our own circumstances, which are different from your neighbor. It's different from your brother or sister. It's different from anybody else. That's what you need to be expert on. If we have a question here, I want to kind of pull this in here about, and please feel free to enter questions in the chat. Happy to answer anything in the live format here. How will the Fed rate increase, presumably affect inflation? The way the Fed is acting right now is heavily influenced by their response to previous crises. So if we think back to the lessons learned, and the Fed's an interesting, animal, because it's only existed for 100 years. The Federal Reserve is not, it's not, our democracy that's been around for 250. It's been around for 100 years, and it was created in response to a constant series of boom and bust. So we had massive expansions, massive depressions. So you look through the late 1800s, early 1900s, it was a series of depressions, which were just transformative for our economy at that stage. But the Federal Reserve was designed to create liquidity to mitigate the impact of depressions in our economy. So now we don't move from depression to depression, we move from recession to recession, some deeper than others. So, and the Fed learns things every time. So there were a lot of mistakes that have been well documented in the Great Depression, where the Fed, swung and missed a little bit. What we're seeing now is the Fed applying the lessons from the Great Recession in 2007, 8, and 9, where they acted and they had massive stimulative programs, and they did a lot of things. But in hindsight, I think they feel that they moved a little bit too slowly. And it wasn't quick, and it wasn't substantial enough immediately in the moment. So when 2020 hit, the Fed acted with extreme action, just pumped liquidity into the market, quantitative easing. They did things that were bigger than 2007, 8, and 9, but they did them very quickly. Now, I think the same still applies, where the Fed's mindset is do it quickly and do it fast. We're not gonna just do a quarter point, half a point. We're going to do 75 basis points or 100 basis point increases, because we need to respond to the crisis quickly, and we need to get back to normalcy quickly. What that means for inflation, I'm not sure we know, because we've never quite seen the convergence of this. This might be the Paul Volcker playbook, where you just have to do things in an extreme way. But I think the Fed's mindset is we would rather do things with extreme action and tamp down whatever we're trying to impact, rather than let things drag out. From a market perspective, what that means is you're going to have a lot of volatility. The market's going to be trying to figure out what pace is happening and what's going to occur. But we're already seeing things like I was pulling up prices of use this example with clients recently. It'll be interesting to see something like wheat prices. Wheat's a good proxy for what's happening in inflation, just because there's a demand element to it, but there's also geopolitics, because with Ukraine being the breadbasket of Europe, wheat prices actually were negative through January this year, and then by March we're up 67-68%. Now they're up 5% year to date. So you've seen this massive spike up in wheat prices, and we've given almost all of it back. In fact, at one point, just last week on July 22nd, wheat prices were negative on the year. We've given up all of that gain. There are a lot of input. That's an input cost for our food basket as well. There are a lot of things that are outside of the control of the Fed that are impacting inflation, that are moving so fast that we don't quite know. We don't have confidence in exactly what's feeding forward. So.
Mm-hmm. Mm-hmm. Yeah.
Katie, one other article that, I'm sorry, did you hear something?
No, go.
All right, one other article that we found, and this ties into, again, taking proactive steps here, the cleaning up, the tidying of portfolios. This fed into your sweet spot here on just simplification and how to streamline your decision making during any kind of crisis. What did that mean? That was a Motley Fool article on just how to clean up your investment portfolio before retirement.
Yes, and it is a lot of the things that we try to assist our clients with, and that we do speak openly about. The benefits of consolidating, by tax structure, making sure that your balance sheet is as clean as possible. Everything on your balance sheet has a specific purpose. So kind of bringing everything together, but then looking inside of there, and at a time when we're still sitting with the broad markets down about 20%, just slightly less, I think about 18-19% on the S&P, and bond market still down close to right around 9%. You could have depressed values in there, which is the perfect time to kind of clean out some of this stuff that maybe you don't need in there anymore. Clean out some of the, maybe there could be individual the stock positions that have, their capital, they might have had capital gains that were pretty inhibitive of being able to move them out of the portfolio efficiently. But now when prices are down, that exposure, that tax exposure is so much less. Or even, and we still continue to see, it's interesting in our industry how much price compression has happened over the past decade or so. But there are still some legacy mutual funds that we come across sometimes in portfolios that have expense ratios of more than 1%, which by today's standards is so high. So being able to clean out some of those more expensive things and just streamline as much as possible, heading into retirement, it makes such a difference, I think, for not only the management, but also your psyche, to be able to kind of know where everything's at and have a good understanding. It really does help to, I think, clear your mind and allow you to focus on the other things.
I was just thinking about something, and I'm sure you've encountered this too. How many times have you gone through kind of a financial plan, and maybe somebody has assets scattered across multiple institutions and things are all over the place. In their mind, they kind of know where everything's parked, but there's a concern about plugging an income gap or filling a particular asset need or something like that. And you realize that there's something parked somewhere over there that would be very useful. I've encountered that in the past where it's like, hey, did you think about using that asset to plug this hole? And the client's like, oh my gosh, I never thought about using that piece over here. And you think, well, that's why just kind of the consolidation is so important, because it's just the alignment that happens. and the stress that goes along with having things just scattered to the four winds. It's unnecessary. Have you experienced something like that before?
Absolutely. Or sometimes that piece is almost forgotten, where
Yes.
it's an afterthought. And then you realize, oh, okay, there is another component here.
Mhm.
And once again, like this is the time to do so much of that work. When you get back to that creative destruction and kind of breaking it open, let's fix it, let's build it better, let's do things that are productive at this time versus being concerned that the world is going to get worse.
Right.
Do you know what I mean? So I think change that focus and to help put the pieces in place so you can have greater certainty for the future. You recognize all the uncertain things around you, but how do you build things in your favor to be able to enhance your certainty looking forward? And I think those are some of the constructive things that can be done.
Yeah. One of the lines in the article they talk about the more scattered your life is going into retirement, the more time you'll spend making sense of it, and the more stress you're likely to encounter.
Mhm.
So I think, when whether this is at or near the bottom, we're definitely in a decline, whether it's called a recession or a bear market or whatever it's called. We're in a decline in stocks and bonds. As we discussed last week, the decline in bonds has been historic. The rise in yields has been historic. But this is when the seeds of next year, 5 years from now, 10 years from now, success are planted. And I worry that the uncertainty and the lack of confidence turns into resignation, saying, throwing your hands up, I'm done. I'm not going to think about this right now. I'm going to wait until things feel good again to address this. And there's so much good work to be done during times like this. And that's the frustrating part. Like, what if you could reconstruct your portfolio owning exactly the things that you want to own and
Mhm.
do it efficiently? Oh my gosh. 5 years from now, you're going to wish that you had done those things right now if it were possible. And in many cases, it can be. You do that tax loss harvesting, you do some other things to reconstruct or even just deploying cash, whatever it might be. But
Mhm.
this is kind of this is where we wrote something about this a couple of years ago. This is kind of the season of no regrets. This is the season where you do those things that your future self says, man, I wish had picked up this at a 20% discount, picked up this at a certain yield, or streamlined
Mhm.
things so that they're made that much easier.
Yeah. You just you mentioned cash again. And for cash sitting on the sidelines, it is interesting to have conversations with people and they say, I have cash here. I feel good about that. I'm going to leave it there. I know at some point I should invest it, but I want to wait till things calm down before. And if it's excess beyond what you need for emergency reserves, and we've, harped that everybody has to have their emergency reserves and it has to be a comfortable amount. But excess beyond that, the question is, what is the danger in waiting till things calm down? Like, where are we going to be when things calm down? What is it going to look like? And where will you be buying at that point when things calm down? And I think that he said that taking a step back and
Mhm.
saying, I'm just not going to do anything right now, that almost that paralysis around the uncertainty and missing the opportunity. You want to make sure you look back with no regrets because that is a I don't want to say dangerous outcome, but that is a unproductive outcome when there are
Yes.
opportunities there.
And I think this speaks to, and again, we're not Pollyannish. We know that bad things can happen, and we have to navigate through those, and that's part of our role. But you have to have the outcome in mind. And I shared with you that Twitter post from Jess Bost at Alpha Architect, where she talked about how a lot of the ways that we think about investing we would never apply to our real lives. And she talked about if you're building a house and you know that it's going to be your shelter in the future, that your abode, the place where your place of safety. If you looked at it under construction, you would never just throw it out. You would never just say, "No, I'm not doing that," and then scrap the whole thing and remove that shelter for the future because you have that vision for what the completed thing looks like, and that's how you should treat your financial plan. Not kind of bailing on it, dumping the investing plan, and saying we're going to scrap this all together just because it looks incomplete. There's always that work to be done, and that's what happens now. is in that messy, unfinished space of a decline in the markets, and that's where the building happens.
And I love that analogy too, because even when the house is built, you're going to continue to refine it. You're going to redo this room, you're going to redo that room, you're going to change the spaces, and that's okay. But the overall structure, it is still there. So
Yes.
I think about that with our financial plans too. Like there's never a total end state. There's a constant refinement, which is a good thing.
Yeah. Yeah. I'll read the tweet here. It says, imagine looking at a partially built house and thinking, that's dumb. It's not providing adequate shelter yet, and deciding to tear it down simply because it's unfinished. If you cared about eventually having a home, you'd never do that. Don't do that to your financial plan. So, your investment portfolio is designed to provide shelter and accommodation in different seasons. And, just looking at it as that useful instrument, as useful as a home is, and not bailing on it. So, all right, this has been a good conversation this morning. Thanks for the questions on inflation and talking ourselves into a recession. Happy to answer any questions that you have. We're going to be coming forward with some more content, especially financial planning related. We're heading into a heavy planning season here in the fourth quarter of this year. That's always an interesting time to be thinking about tax efficiency and what best moves you can make to position yourself for future success. So thanks for joining us this morning, and we'll catch up with you soon.